Great to have you back on the show. Welcome.
Thank you for having me on the show, Sarah.
So clearly you are optimistic about the growth of the U.S. economy. Does this factor in the Biden plans, infrastructure and families, which you seem to endorse? Does that add to growth?
The projections for 7% growth is on the strength of what has already been done as policy support for the U.S. economy, and on the strength of vaccinations that have opened up the opportunity for consumers to consume and for producers to step up. When we look into the next years, yes, we do factor the two plans, the jobs and the families plans that the administration is putting forward. Between now and 24, we expect that they would add cumulatively 5.25 percentage points to U.S. growth. But most importantly, because they concentrate on improvements in physical infrastructure and in human capital, we expect lift of productivity in the U.S. and a continuous boost to U.S. growth by 1 percentage point until the end of the decade. So all in all, good news in the short term, but also we project a positive development for U.S. competitiveness, jobs, and growth, and done with attention to inequality in the United States.
So the other big question in the U.S. is inflation right now, and it sounds like you're siding with Fed Chair Powell, using the word transitory in this report. My question to you, Madam Managing Director, is what is transitory? Because housing prices have now been rising in this country for months. These semiconductor shortages are set to last for years. So at what point does it become more concerning?
We are concerned about inflation this year because of this incredible boost of demand while we still have supply-side interruptions. And these supply-side interruptions are likely to continue. And let's remember, they are also driven by what is happening in the rest of the world. As long as the U.S. economy is booming, but held by slow vaccinations, other countries are not, we may still witness some of these supply disruptions. This being said, the evidence so far is clear that while prices may be jumping, we put it in the order of up to 4% for this year. By the end of 22, we anticipate inflation to go down to around 2.5 percentage points. We are emphasizing in our report 2 points. One, be watchful. And thankfully, Chair Powell, the Fed, are very watchful. They're very careful in monitoring what is happening. And two, be sure to communicate clearly what is the guidance with regard to both inflation and inflation expectations. And I want to stress that we are encouraged to see more attention being paid to systemic issues like housing in the proposed plans, because there is an intention to boost, especially for low-income housing, to boost the supply to ease this pressure on pricing.
So having said all that, you do expect tapering to begin in early 2022, according to this report, and rate hikes to begin end of 2022 or early 2023. How does how is that process going to look? Is that going to go smoothly, or is that the end of the expansion because it'll tighten financial conditions and cause a market downturn?
I mean, let's be fair that this is driven by good news. The economy is booming. People are out there shopping. And that is creating an environment in which there is upward pressure on prices. Now, we do expect this to be an orderly and well-defined process. The Fed so far, applying their new framework, has done a really good job in communicating to the public how they see the impact of this high growth, increase in prices on monetary policy. We anticipate the sequencing you just described, that we would see tapering done sometimes early next year. We would see interest rates eventually going to more normal place by the end of next year, early 2023. And what we are particularly watchful, and I want to put this to your audience to be mindful of, is the spillover for the rest of the world. Now we are enjoying positive spillover. Strong growth in the United States transmits into better performance in other economies, especially those integrated with the US economy. But if we have these divergent recoveries, Sarah, that we are observing now, with advanced economies vaccinating and pulling out of the pandemic, and many emerging markets, developing countries falling behind, we might be in a situation in which interest rates in the US may normalize, and that could turn into a headache for countries with high level, especially of dollar-denominated debt.
Shepard Smith here. Thanks for watching CNBC on YouTube.